Look, I need to tell you about something that happened in London back in 1960 that's about to repeat itself. And if you own gold right now, you need to pay very close attention because what I'm about to share with you could mean the difference between protecting your wealth and watching it evaporate. Picture this. It's early morning, March 1968, and in a wood-paneled room in the Bank of England, 7 men from the world's most powerful central banks are sitting around a mahogany table. They've been running what they call the London Gold Pool for 8 years, secretly buying and selling massive amounts of gold to keep the price artificially pinned at $35 per ounce. The American government needs this price to stay fixed because their entire monetary system depends on it. But there's a problem. France just pulled out of the pool. They're done manipulating the market, and now these 7 remaining central banks are hemorrhaging gold at a terrifying rate, selling hundreds of tons every single week, trying to hold back a tidal wave of buying pressure from investors who can smell blood in the water. On March 14th, they sold 100 tons of gold in a single day. The next day, 200 tons. By March 15th, they'd lost so much gold that they had an emergency conference call at 3 in the morning and made a decision that would change financial markets forever. They closed the London gold market completely, shut it down, and when it reopened, the price of gold exploded, nearly doubling in just months. And the investors who understood what was happening made fortunes, while the central banks who fought against the market bled billions in losses. Now here's what I need you to understand about why I'm telling you this story today. My name is David, and I spend way too much time thinking about monetary policy, central bank manipulation, and what's really happening behind closed doors in the financial system. If you're someone who owns gold or is thinking about buying it, and you're wondering whether this is the right time or the worst possible time to be a gold investor, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because what I'm going to show you today is going to completely change how you think about your gold position. Here's what's happening right now. Gold is in the middle of one of the most violent and confusing periods in its modern history. We're seeing central banks buying record amounts, over 1,000 tons per year, the highest levels since the early 70s. At the exact same time, we're seeing massive volatility, price swings of $50 to $100 in a single day, and a disconnect between physical gold markets and paper gold markets that hasn't been this extreme since 1968. By the end of this video, you'll understand the exact mechanism that major financial institutions are using to suppress gold prices in the short term while accumulating massive positions in the long term. And more importantly, you'll know exactly what you need to do to make sure you're on the right side of this trade when the manipulation finally breaks down, just like it did in 1968. As usual, I need to tell you a story because the pattern that's playing out right now in gold markets is not new. It's happened before, multiple times, and every single time it follows the same playbook. The people who recognize the pattern early make life-changing money. The people who don't, well, they're the ones providing that money. Let me take you back to London in 1960. The world had just come out of World War II, and the entire global monetary system was built on something called the Bretton Woods Agreement. Here's how it worked. The US dollar was pegged to gold at exactly $35 per ounce, and every other major currency was pegged to the US dollar. This meant that foreign governments could, in theory, take their US dollars to the Federal Reserve and exchange them for physical gold at that fixed price. Now, this system worked great for the United States right after the war because they held most of the world's gold, about 20,000 tons, more than 70% of global official reserves. But here's the problem. The United States started running budget deficits. They were spending money on military programs, on the space race, on social programs, and they were printing dollars to pay for it all. More dollars in circulation meant more claims on the same amount of gold. Other countries, especially France under Charles de Gaulle, started to notice this. They looked at the math and realized that America was creating way more dollar liabilities than they had gold to back them up. So France did something brilliant and ruthless. They started exchanging their dollars for physical gold, demanding delivery from Fort Knox. Other countries started doing the same thing. By 1960, the US gold reserves had fallen from 20,000 tons to around 15,000 tons, and the outflow was accelerating. So what did the central banks do? They panicked. But instead of admitting the system was broken, they decided to manipulate the market. In 1961, 8 countries formed the London Gold Pool: the United States, the United Kingdom, West Germany, France, Switzerland, Italy, Belgium, and the Netherlands. Their goal was simple: keep the price of gold at $35 per ounce no matter what. Here's how it worked. When private investors tried to buy gold and the price started to rise above $35, these central banks would flood the market with physical gold from their reserves, selling hundreds of tons to push the price back down. When demand eased and the price threatened to fall below $35, they'd buy gold back. It was pure price manipulation, using the combined gold reserves of 8 nations to overwhelm market forces. And for a few years, it worked. The price stayed remarkably stable. Private investors who tried to bet against the pool got crushed because they were fighting the combined resources of the world's most powerful governments. But here's the catch. Every time they sold gold to suppress the price, they were depleting their reserves. And the fundamental problem wasn't going away. The United States was still running deficits, still printing dollars, still creating more claims on gold than gold actually existed. The pressure kept building. By 1965, the London Gold Pool was selling more gold than they were buying back. By 1967, the situation was getting desperate. They were selling hundreds of tons per month. And then France, seeing that this was a losing battle, withdrew from the pool in the summer of 1967. Now, there were only 7 countries holding back the flood. Why would they do this? Because admitting defeat meant admitting that the dollar was overvalued, that the entire Bretton Woods system was a lie, and that decades of monetary policy were built on a foundation that was crumbling. The political cost of that admission was too high, so they kept fighting. The crisis point came in early 1968. In March, the selling accelerated to levels that were simply unsustainable. On March 14th, the London Gold Pool sold 100 tons. On the 15th, they sold 200 tons. In just 3 days, they sold nearly 400 tons of gold, and the buying pressure wasn't slowing down. Investors around the world could see the pool was losing control. On the morning of March 15th, 1968, the remaining members of the pool had an emergency conference call at 3 a.m. London time. They made a decision. They would close the London gold market completely, shut it down, and when it reopened, they would announce a 2-tier system. Central banks could still exchange gold with each other at $35 per ounce, but the private market would be allowed to float freely. When the London market reopened, the private price of gold shot up. Within months, it was trading at over $40 per ounce. By the early 70s, when President Nixon finally ended the dollar's convertibility to gold completely in 1971, gold exploded to over $100, then $200, and eventually peaked at over $800 per ounce by 1980. Investors who understood that the London Gold Pool was fighting a losing battle and positioned themselves accordingly made absolute fortunes, returns of 10 times, 20 times their initial investment. The central banks who tried to suppress the price lost thousands of tons of gold, wealth that flowed directly from government vaults into the hands of private investors who saw through the manipulation. And here's the kicker. While the central banks were publicly claiming everything was under control, insiders were quietly accumulating gold for their personal accounts. Bankers who managed the pool during the day were buying gold for themselves at night. They knew the manipulation couldn't last. They knew the math didn't work. They profited enormously while telling the public that gold was a barbarous relic with no investment value. So what does this have to do with what's happening in gold markets right now? Everything. Just like the London Gold Pool created artificial price suppression by flooding the market with physical gold, while fundamental imbalances grew larger, modern financial institutions are suppressing gold prices using paper derivatives, futures contracts, and unallocated gold accounts, while central banks and smart money accumulate physical metal at a pace we haven't seen in 50 years. The mechanism is different, but the pattern is identical. Now, I know what you're thinking. How can the price be suppressed if central banks are buying? That seems like a contradiction. Let me explain this with something you'll understand immediately. Imagine you decide to buy a car, a nice used sedan worth about $30,000. You go to a dealership and the salesman tells you they have the perfect car for you. You can drive it home today without paying the full $30,000 up front. Instead, you just need to put down $3,000, 10%, and you'll have a certificate that says you own the car. The car stays at the dealership's lot where it's safe and insured, but it's yours whenever you want it. You agree because it sounds convenient. You invest your remaining $27,000 elsewhere and earn returns on it. Now here's what you don't know. The dealership just sold that same car to 9 other people using the exact same deal. 10 people think they own one car. Everyone has a certificate. As long as nobody actually asks to take physical possession of the vehicle, the dealership is fine. They've collected $30,000 in down payments for a car they only own one of, and they've pocketed the difference. But then economic conditions change. People get nervous. 3 of those certificate holders show up on the same day and say, "I want my car, I'm taking physical possession." The dealership panics. They only have one car. They can give it to one person. For the other 2, they offer excuses, delays. Maybe they offer to buy back the certificate at a slightly higher price. Anything to avoid admitting they sold the same car 10 times over. If all 10 certificate holders showed up demanding the actual car, the entire scheme would collapse immediately. This is exactly what's happening in gold markets right now. Except instead of cars, it's gold bars. And instead of 10 claims per car, estimates suggest there are somewhere between 50 to 100 claims on every ounce of physical gold actually sitting in vaults. You can buy gold through futures contracts, exchange-traded funds that claim to hold gold, unallocated gold accounts at banks, digital gold certificates, all of which are essentially pieces of paper that say you own gold. But the vast majority of those paper claims are not backed by actual physical metal. They're backed by the promise that if you ever want to convert your paper into metal, the institution will find it for you somehow. As long as most people are content holding paper certificates and never asking for delivery, the system works fine. But the second a significant percentage of paper gold holders say, "I want the real thing, ship me the bars," the entire structure breaks down because the physical gold doesn't exist in the quantities the paper claims suggest. Now, here's where it gets really interesting. While retail investors and pension funds have been buying paper gold, thinking they're getting exposure to gold prices, central banks around the world have been doing the opposite. They're buying physical metal, taking delivery, and storing it in their own vaults. In 2022, central banks bought over 1,000 tons of physical gold. In 2023, they bought another 1,000 tons. These are the highest levels of central bank gold buying since 1967, right before the London gold pool collapsed. Poland, China, India, Turkey, even countries like Singapore and the Philippines are adding hundreds of tons to their reserves. These are not stupid institutions. They understand the difference between paper claims and physical metal, and they're choosing physical. So we have a situation where the price of gold, which is set primarily in paper markets like the COMEX Futures Exchange in New York, is being held down by the infinite supply of paper contracts that can be created out of thin air. But the physical market, where actual bars change hands, is getting tighter and tighter as central banks and sophisticated investors drain physical supply. This creates a divergence. Paper gold prices can be suppressed through manipulation and unlimited contract creation. Physical gold is disappearing into central bank vaults where it's not coming back out. Eventually, just like in 1968, the paper market will lose credibility, and when people rush to convert paper into physical, the price will explode. Because there simply isn't enough physical gold to satisfy all the paper claims. Now let me introduce you to the villains in this story, Because just like the London gold pool had specific central banks manipulating prices, today's gold suppression has specific players who benefit enormously from keeping prices controlled. The primary players are bullion banks. These are major financial institutions. Think JP Morgan, HSBC, Goldman Sachs, that act as middlemen in gold markets. They facilitate trades for central banks, they run unallocated gold accounts for wealthy clients, and most importantly, they trade massive positions in gold futures and derivatives. Here's their motive. These banks make money from volatility and flow, not from the actual price of gold going up or down. What they need is a stable, controlled market where they can front-run orders, collect fees on transactions, and use their knowledge of client positions to trade against them. A wildly volatile gold price, or worse, a gold price that rises so high that it exposes the fractional reserve nature of the paper gold system, would be catastrophic for their business model. If clients started demanding physical delivery en masse and the banks couldn't provide it, they'd face legal liability, regulatory scrutiny, and the collapse of a very lucrative revenue stream. So how do they suppress the price? First, they use futures market manipulation. Gold futures trade on the COMEX exchange, and the price is set by contracts that promise delivery of gold at a future date. Here's the key. Less than 1% of futures contracts ever result in physical delivery. Almost everyone settles in cash. Knowing this, bullion banks can sell enormous quantities of paper gold futures contracts during thinly traded hours, often in the middle of the night or right before market close, to push the price down. They're not selling real gold. They're selling promises to deliver gold that they never intend to actually deliver because they know the contracts will be closed out for cash. This creates artificial selling pressure that drives the price down, triggering stop losses from retail traders and creating the impression that gold is weak. Second, they use unallocated accounts to create phantom supply. When you open an unallocated gold account at a major bank, you're essentially lending the bank money, and they promise to give you gold equivalent to that amount whenever you want. But the bank doesn't actually set aside your specific gold bars. They pool everyone's gold claims together and only keep a fraction of physical gold in reserve, maybe 10%, maybe 20%. The rest they use for their own trading and lending. This allows them to create far more claims on gold than they have actual gold, inflating supply on paper while physical supply remains scarce. It's fractional reserve banking applied to gold. Third, they use central bank gold leasing. Central banks lease their gold reserves to bullion banks at very low interest rates, sometimes less than 1% per year. The bullion bank takes this physical gold, sells it into the market to suppress the price, and uses the proceeds to invest in higher yielding assets. They profit from the interest rate spread. Eventually, they have to return the gold to the central bank, but they're betting they can buy it back cheaper later or simply roll over the lease indefinitely. This puts physical gold into the market temporarily, increasing supply and putting downward pressure on price, even though the gold technically still belongs to the central bank. Here's what most people don't realize. These tactics only work as long as confidence in the paper system remains intact. The moment a critical mass of investors loses faith and demands physical delivery, the entire scheme unravels, and we're starting to see cracks. In recent years, there have been repeated delivery delays at major vaults. Premiums for physical gold coins and bars have spiked well above the paper spot price, sometimes 10 to 15% higher, indicating that physical is scarce even when paper prices suggest abundance. Some countries have repatriated their gold from foreign vaults. Germany famously took years to get their gold back from New York and Paris, suggesting that the gold either wasn't there or was being used for something else. So the banks and institutions suppressing gold prices are doing it to protect their business model, to keep collecting fees, to avoid the embarrassment and legal consequences of being exposed as running a fractional reserve gold system. But here's the emotional reframe you need to understand. You're not a victim in this. You're actually in a privileged position. You're watching a manipulation scheme in real time. You understand the mechanism, and you have the opportunity to position yourself on the right side before it collapses. The central banks know this. That's why they're buying. The insiders know this. That's why premiums on physical are rising. The only question is whether you're going to act on this information or wait until everyone else figures it out and the price has already exploded. So, what do you do today, right now, to protect yourself and position for what's coming? Here's your immediate defensive move. And this is specific. If you own gold through an exchange-traded fund like GLD or IAU, go into your account today and check the fund's prospectus for the section on physical redemption rights. What you're going to find is that you, as a retail investor, have zero right to redeem your shares for physical gold. Only authorized participants, which are large financial institutions, can do that. And even they need to hold a minimum number of shares, usually representing at least 10,000 ounces or more. This means your ETF shares are just another form of paper gold. If a crisis hits and you want physical metal, you'll have to sell your shares for cash and then try to buy physical in a market that's likely to have massive premiums and shortages. You'll be at the back of the line. Instead, if you're serious about gold as insurance against monetary instability, you need to own physical metal that you can hold or that's stored in an allocated account in your name. Allocated means specific bars with serial numbers are assigned to you and segregated from the vault's other holdings. The storage company cannot lend them out or use them for anything else. This is completely different from unallocated accounts where you just have a claim on a pool of gold. Yes, allocated storage costs more. Yes, buying physical coins or bars comes with higher premiums than paper gold. But that premium is the price of actually owning the asset rather than owning a promise. And when the paper system breaks, that premium will look like the smartest money you ever spent. Here's the second thing you need to understand. The ratio between gold and silver right now is historically extreme, sitting at around 80-1 or higher. That means 1 ounce of gold buys you 80 ounces of silver. Historically, that ratio has averaged somewhere between 50-1 and 60-1. When gold becomes scarce and expensive, industrial and investment demand often shifts to silver as a more affordable alternative. Silver is also used in far more industrial applications than gold, including solar panels, electronics, and electric vehicles, which means it has dual demand from both investment and industry. If gold explodes higher due to paper market breakdown, silver typically outperforms on a percentage basis. It's more volatile, yes, but for investors who understand the pattern and have a higher risk tolerance, adding physical silver alongside gold can amplify returns when the manipulation finally breaks. The key word is physical. Paper silver has the same fractional reserve problems as paper gold, maybe worse. Third, pay attention to the spreads between paper and physical prices. If you see premiums on physical gold coins rising from the normal 3 to 5% over spot to 10, 15, or 20%, that's your canary in the coal mine. It means physical supply is getting tight and people are willing to pay significantly more than the paper price to get real metal. That's the early warning signal that the paper market is losing credibility. When you see that happening, it's time to either buy more physical immediately or at minimum, make sure everything you own is allocated and not just a claim on a pool. Fourth, ignore the short-term volatility. If you understand that paper markets can be manipulated through future selling and that physical markets are tightening, then you have to expect wild price swings. The banks will use every tool they have to shake out weak hands, to trigger stop losses, to create panic selling. They'll dump contracts at 3 in the morning to create the appearance of a breakdown. They'll coordinate with negative media narratives about how gold is a barbarous relic or how cryptocurrency has replaced it as a store of value. All of this is noise designed to separate you from your position before the real move happens. If you own physical gold as insurance, the day-to-day price is irrelevant. What matters is whether you'll have it when the system breaks. And finally, understand the psychology of what's coming. When the London gold pool collapsed in 1968, it wasn't a smooth, gradual process. It was sudden. One day, the market was open and suppressed. The next day, it was closed. When it reopened, the rules had changed and the price exploded. The same thing will happen with the modern paper gold system. There will be some triggering event, Maybe a major bullion bank fails to deliver on a large contract. Maybe a country demands repatriation of their gold and it's not there. Maybe a whistleblower exposes the fractional reserve ratios. Whatever it is, the breakdown will be fast. By the time it's obvious to everyone, physical gold will either be unavailable at any price or available only at prices double or triple the old paper price. The people who recognize the pattern early and positioned in physical metal will be protected. The people holding paper promises will be trying to exit through a door that's already jammed shut. Look, I'm not here to tell you that gold is going to the moon next week or that you should put your entire net worth into coins and bury them in your backyard. What I'm telling you is that the same pattern that played out in 1968 when central banks tried to manipulate the gold price and failed spectacularly is playing out again right now with paper derivatives and fractional reserve bullion banking. The math doesn't work. You cannot have 100 claims on every ounce of physical gold and expect that system to survive when people start asking for delivery. And the fact that central banks are buying physical at the fastest pace in over 50 years tells you everything you need to know about what the smart money thinks is coming. This is not some conspiracy theory. This is how markets work when there's a fundamental imbalance between paper claims and physical assets. It happened with mortgage-backed securities in 2008, when everyone realized the underlying mortgages were garbage and the securities were worth far less than claimed. It happened with the London gold pool in 1968, when the claims on gold at $35 per ounce exceeded the physical supply and the price exploded. And it's going to happen again with paper gold, because the imbalance is even more extreme now than it was then. The only question is when, and whether you're positioned correctly when it does. So go check your gold holdings today. Make sure you know whether you own paper or physical. Make sure you understand whether you have redemption rights or just a claim on a pool. And make sure you're not going to be the person stuck holding a certificate for a car that was sold to 99 other people when you show up to take delivery. Because in the end, in a real crisis, paper burns and metal doesn't.